Hey guys, Elliot Director back with another video. This is episode 3 of Capital Matchmaking, and we're going to discuss today financial disclosures and what they are. So, most important thing is, we went through infrastructure, we went through team and why you need that, and of course, now we're heading to the process in which we're ready to prepare the financials, we're ready to prepare the company's documents to make it presentable, to make sure that all the numbers make sense for an investor to feel enticed, for them to feel like they want to invest, and for them to feel, in a way, motivated, and of course, perceive that the success in your company will lie in making the profits that you promised them, right? So when it comes to financial disclosures, there are a couple of rules that you want to follow. These are basic rules, but they need to be followed regardless. So the first thing you want to do is you want to, like I said, you want to make sure that your accounting is up to date. You want to make sure that you have filed your taxes up to date. You want to make sure that you have all the information in relevance to anything that deals with financing with your company, whether you borrowed money before, are you up to date with your payments, are you behind? Anything that's financial disclosure, you need to have that information ready because these are the things that will help investors kind of navigate through the space of your company and, of course, understand your financing, understand what your needs are, why you need to raise that capital in the first place, because that is a financial request, and for them to get the clarity in a very concise way so they can say, okay, look, I know that this company needs money because they want to fix their credit by paying off existing creditors or people they owe money to, and our investment is basically going to help them exit. In addition to that, is going to help them move forward. So if that's the circumstance where you're essentially raising capital to swap a certain position, to put yourself in a very more comfortable spot so that your company can move ahead through an investment help, then that's definitely the point where you want to mention all that information and have it clearly described in your financial statements. And then, of course, at other times, when there are certain numbers that are not clear, for example, why you need X amount of dollars, how are you going to spend that money? You need to have all that clearly highlighted. The use of proceeds is very important. In the investment banking industry, if you don't have use of proceeds and you don't have pro formas, which are essentially projections for, let's say, the next year, 2 years, 3, 4, 5, even 10 years, these are the numbers that investors will look at, or even their analysts will look at if they have a huge team, and will make a determination on whether or not it's a viable option for them, and based on their current appetite and where they're at in terms of allocation of their own capital as investors, to see if it fits with their needs. Because sometimes what happens, right, is behind the scenes, when a lot of people think, like, just go out to investors, they have money sitting around, and they'll invest in your company. That's not the case. Okay, what happens is a majority of the times, you're going in front of investors who have an allocation strategy. And what that means is they have a guideline and a mandate and how they're going to spend that money. So if you look at, for example, big firms like, pension funds, endowment funds, retirement funds, those specific companies and institutional models have a charter. A charter is essentially a guideline in which how they can spend the money, what kind of companies or investments they can make, what type of risk disclosures they're willing to accept, and how much of a threshold in terms of stress testing they can uphold in terms of endurance. So all these type of things are listed in charter. All these type of rules and guidelines in terms of investment capital is listed in that charter. So when you create your financial disclosures or your statements, one of the biggest and most important thing to focus on is really understanding, okay, well, who am I going to be servicing in terms of investor, right? And what I mean by that is the type of company that you have. There's a certain type of investor that you have to go with. And I say this with interesting thought, because a lot of people, when they go in the first time they're trying to raise capital, they don't have a perceived type of investor, like a persona of an investor that they feel would be the ideal fit for their company. Now, this is very important when you're doing this, when you're creating your financial disclosures and statements. The actual statement itself, the actual financial information itself, has to be catered to that particular type of investor that you're aiming for. Okay. So a lot of people in this business, right, when they're trying to raise their capital, or let's say you go and hire somebody like an investment bank, and you're gonna probably end up spending like more than 250,000 or even 300,000 if you go through an investment banking route. But what they're going to do is they're going to put the numbers together, and essentially, after those numbers are put together, there was really no criteria. All they're going to do is pick up the phone and call all their databases that they have, and hope to meet some investments. And of course, being an investment bank, they have the credibility, the team, the research, the brand. In most cases, they will be successful, but it will take some time. Now, if you want to do it in a more concise and more precise way, the first thing you want to do is you want to kind of figure out exactly the type of investor you want to target. So if you're in the manufacturing industry, you want to aim for investors who actually have done manufacturing and are looking to expand their existing portfolio. And sometimes, believe it or not, even some competitors who are at the top game, can be investors, because collaboration can sometimes be a way of succeeding so you can take your company to the next level. So again, when you're creating these financial disclosures, when you're creating these documents and these performance and these projections, you always want to have those things in mind. Always think about creating financial projections and performance around the ideal investor that you want to target. Think about, what are their criteria for investing? Do some research. Go on the internet or even go in like different databases or websites that do like private equity, venture capital, angel funds, seed, or even search funds, and look at those databases and read some news in terms of like their investment criteria. Look at some financial statements in public companies, the S1 forms and all these type of disclosure forms that are available on the SEC's website and see, okay, well, how much of that money is going into goodwill? What are some of the criteria for investing in those type of companies? And then, of course, what exactly are they looking for? Of course, you're going to always see, based on our first video, we talked about infrastructure. You're always going to see, okay, well, we're looking for this type of team to invest in, et cetera, et cetera. And from those information and from the collection of all that data that you gather, create the financial disclosures, make sure that it makes sense for a company, and then aim for getting investors. So I hope this video was helpful. My name is Ali Arthur, your guide and mentor. This was episode 3 of Capital Matchmaking. I hope to see you next time. Bye for now.